of Zoom sessions where we just sort of build on what we've been talking about in the chat, and we'll have quizzes going forward. We're going to review the quiz today, and so whatever questions you attempted but wasn't able to answer, hopefully we'll get that squared away today, and then any other questions you might have, we'll review that. And then at the end, I just kind of want to show this little demo of this on-demand feature in Thinkorswim. And I think that'll be it. So we got a hard cutoff at 7, and so we'll get as far as we can, and hopefully we'll get through it all though. So let's see. In the chat, so if everybody has access to the chat, if you can just put a 1 in the chat if you attempted the quiz at all. 1 in the chat if you attempted the quiz. Sabrina attempted the quiz. Antoinette. Okay.
I'm sorry, Bruce, he's meaning in the Zoom chat.
Okay, yeah, I'm slow.
That's okay. That's okay. Just trying to see who's motivated. So at least most of the people on the chat or on the Zoom session tried to work out the quiz. How was it? Difficult, easy, breeze?
The second page was a little challenging.
Okay.
Page 1 was easy, but the second page was a little.
Okay. So we're gonna walk through it. And as we go, stop me if we got questions, because the whole goal is to make sure when you walk away from this session that you have a better understanding of the Greeks. All right.
Will that make oxygen go to 20?
Say that again now.
I said, learning these Greeks, will that make oxygen go to 20?
We'll see tomorrow, huh? Okay. So let's see. Here's the quiz. So part of the ground rule was that, you know, with the Greeks and with these options premiums, they all sort of interact with each other. And so there's no good way to isolate those. So if you're looking at stock price action and the options premiums alongside that, you know, these Greeks are interacting with each other. So it's hard to say which one is doing what at any given time. But for the sake of understanding what each of them do individually, we're just assuming that we're taking a snapshot in time and we're just looking at one of these in isolation. So we'll go through this quiz assuming that. And if we got questions, just let me know. Okay, so the first question is select all the Greeks below that are variables in options pricing. Should be straightforward. So assume nobody chose alpha or beta. Everybody get gamma?
Yes.
Okay. Delta?
Yes.
Yeah.
Okay. Anybody choose epsilon? Kappa? I hope the answer is no to both of those.
I guess not.
Yeah, so neither one of those are correct. Theta?
Yeah.
Yeah.
Omega?
No.
Sigma? No. Rho?
Yes. Yes.
Can anybody tell me which one I didn't include in this list?
Vega.
Exactly. So Vega wasn't included, but it is covered on the second page of the quiz. So good job. Okay, so I got a couple people with questions on number 2, so we'll just go through it. So check all that apply. Y'all remember from the last session, I said that delta is pretty important and it represents a number of things. And so it's one of the key Greeks that you really want to walk away from this, and going forward, you really want to make sure you understand what all delta represents. So if you got questions on it, let me know. Okay, so check all that apply. Delta represents the probability of an option expiring in the money. Who chose that one?
Yes. I did.
I hope everybody did.
Mhm.
Okay. Delta represents the probability of an option expiring out of the money.
No.
Nope. So it does not. But if you wanted to calculate the probability of something of a option expiring out of the money, you just take 1 minus delta, right? So I have a delta of 0.4, then 40% chance of that option expiring in the money. 1 minus 0.4 is 0.6, so 60% chance of it expiring out of the money. And if you are a seller, then you are interested in the probability of it expiring out of the money, worthless. If an option expires worthless, you keep all of the premium that you collected up front. That makes sense?
Yes.
Okay. For every dollar move of the underlying stock price, the option premium changes by delta. Everybody choose that one?
Yes.
Yeah.
Okay. So that's sort of the fundamental definition of delta. So that's exactly what it does. And that's both ways, right? So not just when the stock price is moving up, but also when the stock is moving down. So delta will decrease the call option if the stock price is moving down by delta. Okay, each option contract represents 400 shares of the underlying stock. And so if that's the case, an option with a 0.5 delta will move like 50 shares of stock.
No.
No.
So anybody else say no?
I guess that's wrong.
That's wrong.
Well, I attempted.
But for the people who sent these in to me, that's the one that people miss the most often.
Yeah.
Okay. And then this last one is false. So delta can be negative, and in fact, if you look at any puts, delta will be negative, right?
Yes.
Okay, so let's talk about that one before. So, so if you can imagine each option contract representing 100 shares, and we already said that delta is basically the multiplier for every $1 change in the stock price. Okay. Let's say you had a delta of 1. So what would happen? Let's say I have an option that has a premium of $5. Okay. And the delta is 1. What happens if the stock price moves up $1?
Goes up
What's the-
dollar for dollar.
It's dollar for dollar. So if you have a delta of 1, then it's a dollar for dollar, right?
That makes sense now. Yeah.
So that means that if I have an option with a delta of 1, it's moving exactly like 100 shares of the stock, right?
Yes. That was a trick question.
It was a trick question, but it's important, especially when you start talking about like leaps. So I know a few people in the group like buying leaps and stuff. So if you're buying deep in the money, you can also think about the strike you choose. Let's say it's like 0.8. So if you choose a strike of 0.8, then that call option is going to move like 80 shares of the underlying stock.
Okay. Okay.
Never looked at it that way. That's cool.
Okay.
So it's not 80 cents per dollar. That's the same thing, right?
It would be, except it's 80 cents on the dollar, but each contract represents, or at least in a lot of these brokers, you still have to multiply times 100, right?
Right.
Yeah. So yeah, but 80 cents on the dollar. So yeah, you can think of that way too. But 80 cents on the dollar is 80%. of the movement. And so that would still be equivalent to 80 out of 100 shares.
Yeah, okay. All about perspective.
Yep. So we're all saying the same thing. Does that make sense? So delta
Yes.
represents quite a bit. So it represents probability of expiring in the money. And so as a buyer, you want to understand how your premium will increase as the stock price moves up if you're buying a call. You also want to understand if you're buying a put, that as that stock price moves down, then the value of your put premium increases. And so when that happens, that means you close, if you wanted to close that position. If you close it for more than what you paid for it, then the difference is what you profit. Okay, so 3 out of 5 of those are all true. Delta does not represent probability of expiring out of the money. You can calculate that by just taking 1 minus delta. And then delta can be positive for calls and negative for puts. Okay. Number
Yes.
3, for every dollar move of the underlying stock, delta increases by gamma. True? True or false?
Guess nobody said answer that one.
I know a couple people did. So
It's true.
the answer is true. Right, exactly. Hang on a second. Let's see. Aisha, can you take care of
Take care of what I'm, who,
like put in the chat, in the options for dummy chat? He's looking for the link.
okay, yes. And I was saying, yes, it's true after the first one though, right? Because after the first dollar, it does delta, but then it goes to the gamma rate after that.
That's correct.
Okay.
So yeah, so the first dollar is just delta, and then think of gamma as an accelerant. So it accelerates delta for each subsequent dollar move of the underlying stock. Okay. So number 4, now we're starting to put that knowledge to the test. So we're going to be doing some number crunching. So call option with the premium of $2.10 has a delta of 0.45. If the underlying stock increases by $3, what's the resulting call option price? Anybody choose 180? Anybody choose 255 and willing to admit to it? 345?
Yes.
Okay.
Yes.
All right. Anybody choose 365? Okay. So the right answer is 345, right? So for every dollar move of the underlying stock, we just multiply in delta, so $3 move. So we multiply $3 times 0.45 and add that to the base premium to get the current premium, 345. Does that make sense?
Yes.
Okay. Number 5, a put option premium of $4.75 has a delta of 0.335. The underlying stock price decreases $5. What's the resulting put option price? So you kind of have to put a couple things together, right? So what happens to put option premiums as the stock price decreases?
It goes down.
Okay, that's
It
one
goes
answer.
up. It goes up
Okay, Sabrina got it.
Okay.
because it's a
So-
put. So,
Right.
yeah.
So if you buy a put, and if you are long on a put option, you're expecting the price to decrease, right? So you profit when the price decreases. So that's your bet. I buy a put because I think the stock price is going to move down. So as the stock price moves down, the premium of the strike that I chose will increase. And so as that increases, I can decide if I hit my profit target, I can exit the trade. The premium is going to be higher when I close that trade. And so the difference between what I paid for it and what its current value is my profit. That makes sense, Raymond?
Yes, it does.
Okay. All right, so put option with the premium of 475, delta of 0.335. The underlying stock moves $5. What's the resulting premium? Anybody choose 308?
I did,
437.
but I was wrong.
Oh, that's okay. Yeah, so that's why this one's kind of tricky because you got to realize, okay, stock price is decreasing, so I've got to add to the value of the premium. 437, anybody choose 437? 643,
Yes.
okay.
Yeah,
509. Anika chose, yep. So yeah, so the right answer is $6.43. So whoever chose that, pat yourself on the back. Who didn't choose that? I think we've got one person that says they did it, but they realized what the mistake was. Anybody else that did not get that and have a question about that?
I didn't get it either, but I understand now.
You understand that?
Yeah.
Okay. Number 6, theta negatively impacts long call or long puts for, it should be asked, for as long as the buyer holds the option contract. True or false?
True.
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 Negatively?
Yes. So if you buy an option, it doesn't matter if it's a call or a put, the thing that is working against you as a buyer is theta, right?
Yes.
So theta will decrease the value of the premium over time. If it's an out of the money premium, then let me see if I have my cheat sheet here. That's not it. Give me 1 second. Can y'all see this?
Yes.
So we'll go into this in more detail later, but I just wanted to show you real quick. So an option premium is made of 2 components. So intrinsic value, so that's the value currently if I were to exercise this contract right now. But then there's also this extrinsic value, which is implied volatility and time value. So there's a time premium associated with all options. And this is associated with theta, this time value. But the theta will decay this extrinsic value down to 0 by expiration date. So if you have an out of the money, call, so if we're looking over here, these are all out of the money because the stock price is lower than the strike you choose in this example. So an out of the money call is 100% extrinsic value. And so that's why if you buy an out of the money call and the stock price doesn't move up past it by expiration date, then it'll be worthless. I think somebody posted in the chat one of their trades and they were like down 99% and they were wondering what to do. Well, you met
That was me. That was me.
that's
This
you,
is
Anika? Okay, okay.
Yeah.
He call you out.
I'm still waiting on that miracle.
You're still waiting on that miracle, but that's an example of an out of the money option. What that is 100% extrinsic value. And so if the stock price remains below that value by expiration date, it'll be worthless. If it were in the money then it would have some intrinsic value and some extrinsic value. But by expiration date, the only thing that's left for an in the money call or in the money put is this extrinsic value. Theta will still decay the extrinsic portion of that premium to zero, regardless of if it's in the money or out of the money. Does that make sense, Aisha? You had that question about that.
Yes, thank you.
Okay. So yes, theta negatively impacts long calls or long puts for as long as you hold it, if you're buying it. On the flip side of that, if you are a seller, then theta works in your favor, because typically we want to sell high, right? So a lot of us are just getting started with selling covered calls. And so we are selling at the top. So we sell at the top, we collect more premium. And then as long as we hold that contract or the buyer holds that contract, and it's below our strike that we sold, then the value is going to be less and less and less and less until you get to the point of expiration, where if it's below the strike price, then that cover call contract is going to be worthless. It goes away. You keep the premium and you keep the shares that you use as collateral to sell that cover call. So as a seller, theta works in your favor. As a buyer, theta works against you. And so you need something to offset theta as a buyer. So usually you need the stock price to move in the direction or past your strike price. Does that make sense?
Yes.
Okay. If it doesn't, I can try and illustrate it a different way. So just let me know. Now's the time to ask. Don't be bashful. If you don't understand, say it. It's being recorded, but that just means the people who are going to be watching later probably have the same question. Okay, so we're assuming everybody's good on that one. Number 7, theta will decay the value of all in the money options to zero by contract expiration. True or false?
False.
False. We kind of just looked at it, right? So if I've got, so this red represents in the money and or intrinsic value, and this little hash version right there is extrinsic value. So theta, even if you have an in the money option, theta won't do anything to this red, but it will decay, the extrinsic value to zero. So if you got an in the money option, theta will not decay that to zero. It'll only decay the extrinsic portion of it to zero by expiration. Okay.
So I got a question on that then.
Yes.
So you have a long, by a leap, for instance. So the value starts to decrease closer to expiration because of the time.
Wait a minute. So say that one more time.
By like a leap, a long call.
Mm-hmm. What about it?
So the value will decrease towards the end, closer to expiration on in the money.
So let's look at that real quick. So this is OCGN. Let's just get the options chain. And so when we're talking leaps, we're talking far out expiration dates, right?
Right.
So if we were to choose, so all of these below this current stock price are in the money, right?
Right.
So this $10 strike is in the money because, wait a minute. Yeah.
No, that's out. That's out. Right.
See, yeah.
So about in the money, right?
Yeah, this is out of money. So we're talking about these up here.
Right.
Sorry about that. So these are all in the money because the stock price is here. And let's say we choose, we can just sort of pick a strike, it doesn't really matter. Actually, so I said that wrong. So these are in the money. So let me just make sure we're clear on that. So these are all in the money.
Oh, that's
These are out of the money. And the way you can tell is by looking at delta as well. So the deeper in the money you go, the higher the delta. And remember the example we talked about earlier, that if you have a delta of 1 or close to 1, then that strike price is gonna move like 100 shares of stock.
yes.
And so it would be, this is the only one that's available, that's that close to 1. And so this 2.5 strike would move like 98 shares of stock, basically 98.3 shares. Okay, so your question was, if I bought a leap, will the value decrease?
Yeah, well, extrinsic, we can do to the extrinsic stuff going on.
Yeah, so for all of these out of the money, so these out of the money strikes, they are 100%
Use,
extrinsic value.
right.
The in the money strikes are a combination of intrinsic value and extrinsic value. And so let's say over time, OCGN doesn't really move. And so January 19th, 2024 rolls around, OCGN is still trading at 1006. These will still hold a lot of their value because a lot of it is intrinsic value. And so all theta will do is decay the extrinsic part of this.
Okay.
Okay.
Mm-hmm.
So that's a good question.
So it's to our advantage to always, if you're going to buy a leap, to buy it ITM in the money.
Yeah, if you're buying a leap, buy it in the money. And then another advantage of buying a leap is that theta is negligible for the most part. So if you look at theta for these contracts,
Less than a penny.
it's less than a penny a day. So theta impacts you. So each day that you hold it, the premium contract, if the stock doesn't move at all, so if the stock moves, then everything changes. So you may have offsets that'll negate theta. But let's say the stock stays where it is, then each day you hold this, the value of your contract will reduce by theta. And so it's to your advantage to go as far out as you can with these leaps, and then as deep as you can. You see how theta gets smaller and smaller. The deeper in the money you go.
Do you recommend 70 to 80 or 80 to 90?
I recommend, 70 to 85-ish. You get into the 90 and higher territory, then
You're buying the stock.
yeah, you may as well buy stock. It'll be a little cheaper, but not a whole lot cheaper.
Okay, so you said 70 to 75.
Yeah, or 70 to 85.
Or 70 to 85.
Yeah. That's just my personal recommendation. You survey 10 people, you may get 10 different answers, and take the average.
Thank
All
you.
right.
Where's the strike price?
To the left.
So yeah, who asked that question? Lightfoot?
Yeah, that was me.
Okay.
That was
So if you're on Webull, it may be different for different brokers, but if you're on Webull, the strike price is over here. And then this is what buyers are offering for each contract. This is what sellers are selling the contract. Somebody mute your mic. So that's what it looks like there. But if you're on Thinkorswim or some different broker, it'll be in a different place. So strike, and it should still, so the way I have it displayed is I only look at calls or puts. So if you're displaying both of them, then it'll be in the middle. The strike price will be in the middle. So if I want to see both, strike price moves to the middle. On the left are calls, on the right are the puts.
How would I pull up that screen that you have?
This screen, do you have Webull as your broker?
Yes, I do.
Okay. So it's just here. I just, you know, all these icons on the far left, you just choose stocks and then options.
Okay, I'm not seeing that on my phone, so I guess I'll have to
Yeah, it's gonna be
look on the
different layout
computer
on
to
the phone.
do it.
It'll be a different layout.
Okay, thank you.
Yep. I'll send you a link to sort of a Webull get to know Webull tutorial.
If he's looking at Webull on his phone, it's across the top, right underneath the stock name. There's charts, options, news, comments.
Yeah. Okay. But I can help you out a little bit later if you're having trouble finding that. So let's keep going. Did I answer your question though about the leaps and how theta might decay a portion of an in the money leap?
Yes, thank you very much.
Yep. Okay, so I think that was number 8. Okay, number 9. A put option with premium 150.50, so pretty expensive. Has a delta of 45 gamma 0.0035 theta of minus 0.33. And let me just show you all that. So if you guys haven't seen put premiums because you never dealt with them, but this is what I meant by, you know, delta will be negative on those. See that? And then theta is going to be negative too, but theta is negative for all options. Okay, theta negative 0.2300, assuming the stock price remains flat, so it doesn't move up or down, just stays at the current price. How much will the put contract value decrease each day? Anybody choose $45 a day? Anybody choose $2.30 a day? 35 cents a day? $23 a day.
23
Right.
dollars.
Yep. So it's basically this value, right, times 100. So if the stock price doesn't move, and this is what you paid for it, then each day you hold this contract, theta will decay that by that much. Make sense?
Yes.
Yes.
Okay. Number 10, rho represents the rate of change between an option premium and the underlying stock's implied volatility. True or false?
False.
False. It does not. We'll learn what actually does in here in the next question. So vega, number 11, vega represents the rate of change between an options premium and the underlying stock's implied volatility. True or false?
True.
True. So let's look at the options again. Okay. So if I have strike price, OCGN expires next Friday, strike price of 25. The premium, the last one that was sold is 15.15. Implied volatility is pretty high, 379. Vega, 0.0056. So if we want to understand what implied volatility movement and Vega does to the premium, then that's what we look at. So for each percentage move of the implied volatility, then the premium is affected by Vega, by this value right here,
By that much. Okay.
by that much, which is not much. So Vega doesn't have a big influence. You know, the bigger influence is going to be delta and theta, like we kind of talked about, depending on what your strike price is.
At what point do we really start looking at Vega and really?
You know, I see, I didn't have it on the chart. You notice I had to pull it up here because it's part of the question set, but I don't really pay attention to it, to be honest with you.
Okay.
Yeah. I you know, it's a quick look when I want to see what it is, but for the most part, I ignore it. But for the purposes of just understanding what these actually do, you know, going through this helps to understand what all of these do. And then we talk about which ones are more important that you need to focus on and which ones are not so important. Okay. So that's what Vega does. So it affects the stock premium, the option premium, when the implied volatility changes. So number 12, it says a call option with the premium $3.50 has an implied volatility of 46%, delta 0.42, gamma 0.0025, theta minus 0.55, and vega 0.095. What's the value of the call option if the implied volatility increases to 50%? So there's a lot of information in there purposely, because you're going to be looking at all of those values when you're deciding which strike price to choose and how it's moving. But when you're just trying to understand what Vega's doing to the premium, you can ignore everything except, you know, the percentage change in the implied volatility and Vega and the premium itself. All this other stuff you can ignore.
I got a question.
Say that again.
I've got a question.
Okay.
Is there like a mathematical formula that you guys are using? Because I don't understand. Like for number 12, the 350, the 46%, the 42, or 0.42. So what is all of that?
Were you able to watch any of the videos?
Yeah, how do you use that to come up with the answers, or the answers that you've given?
Mm-hmm. So most of these are made up and there's only one right answer, right? So if you're doing the calculation right, then it'll be obvious which one of these is right. So when we say that for every percentage increase in implied volatility, the premium increases by Vega. So that's what we're kind of doing. We're defining, like in number 11, we're defining what Vega does, right? And so we said it's the rate of change between the option premium and implied volatility. And so now we're just doing a calculation based on that understanding of the definition. So
Okay.
if implied volatility changes by 4%, then we should be multiplying vega by 4, and adding that total to the premium to come up with the new premium.
Right.
Does that make sense?
Yep. And all the other numbers were just a smoke screen, basically.
It's not a smoke screen. I mean, you're going to be seeing those numbers, right?
I mean, when it pertains to this question.
Yeah, I mean, I can make it easier for you and just turn the crank, but that's not the idea. The idea is to make sure you understand it. Which of these values do you use when you're trying to understand how vega and implied volatility impact?
Okay, right.
Yeah. So yeah. Anybody choose 385? What about 358? 388?
Yes.
Yeah.
Okay.
Yes.
So 388 is the right answer. And obviously 453 is wrong. Okay, so it sounds like everybody understands that. Good, good. And like, if you don't understand, that's fine. We'll get you caught up. Don't worry about it. Number 13, a put option with premium $2.90 has an IV of 135%, delta 0.78, gamma 0.019, theta minus 0.065, and vega 0.05. What's the value of the put option if the implied volatility increases to 140%? Anybody to $5.05? 315?
Yes.
Yes.
Okay. Anybody choose 429 or none of the above? Okay, so the right answer is 315. It sounds like people chose that. Good. Okay. So these last two are just true, false. Gamma represents the rate of change between an option's delta and the underlying asset's price. So we already had an example of that above, right? So gamma indicates the amount the delta would change given a $1 move in the underlying stock. And then they've got an example there. We don't need to read through all that. So everybody choose true?
Yeah.
All right, the answer is true. And this also says, it doesn't really matter which way the stock moves. Gamma will impact delta in the same direction as the stock moves. So if the stock price decreases, then gamma will reduce delta by gamma. If the stock price increases, gamma will increase delta by gamma. Okay, so last one, talking about rho. So rho represents the rate of change between an option's value and a 1% change in the interest rate. This measures the sensitivity to the interest rate. True or false?
True.
True. Good. So that's it, y'all. What questions can I answer about the Greeks? I could have made this twice as long if we wanted to, but really just wanted to introduce these Greeks, give some examples, let you practice with the calculations, and then we'll start building on this later. But any questions about the Greeks?
I'm sorry, I didn't get the last one, 15.
So 15, yeah, rho. So rho is true. So the answer is true. But it's a negligible rate that it's another one that we really don't pay much attention to. So if you look at it, For the most part, these end up being really small numbers. And they really don't register when it comes to impact on the overall option premium. So we just introduced it, with the definition and number 15. But going forward, we'll probably hardly ever talk about growth because it's sort of in the noise. And so it doesn't really matter. What else? Other questions?
So I have a question on number 13. I know you went over it, but I guess for me, number 13, it moved from 135% to 140%, which means, were we supposed to have done the math to see how many dollars that was first to determine? Or that
No.
was strictly, okay.
So yeah, that's a good question. And I'm sorry if I breezed over that, but it's simply trying to understand how vega impacts the stock of the option premium. And so for every 1% change in implied volatility, the option premium changes by vega.
Oh. Okay.
Does that make sense? And so, by the way, most of these Greeks, we're talking about an increment of 1 and something. So in case of vega, we're looking at a 1% change in the implied volatility. In the case of delta, we're looking at a $1 change in the underlying stock price, right?
Yes.
So think of it that way. So for every percentage change in the implied volatility, the premium will either increase or decrease depending on the direction by vega. And so in this case, in number 13, implied volatility increased 5%. So we're just saying 5 times vega, then we add that to the premium and we get 315.
Thank you.
Does that make sense?
Yeah, I was going back to gamma. So yes, thank you.
Okay.
It all makes sense today, but
That's all right. It'll make sense tomorrow. I'm gonna send this out, by the way, with the answers, but you guys pretty much had most of these answers right, so that's great. What else can we talk about on Greeks?
so as far as the main Greeks that we should pay attention, I know we should pay attention to all, but the main ones I think would be delta and theta, correct?
Yes. Delta and theta are pretty much the ones I pay attention to. And since I mostly sell options, then I look at theta just to get an idea of how fast how fast that contract is going to decay for the person on the other side of that trade. So if I'm a seller, then somebody on the other side will have bought that. And so I might look at theta to say, okay, this is going to lose X number of dollars per day through expiration to give me an idea of how fast that might decay. So one thing about theta, the closer to, so let's say we got an out of the money option that we're either buying or selling. The closer to at the money, so the closer to the current stock price, the higher the theta. So the closer to the current stock price, the more it would cost you to get into the trade, which means the more value that theta has to decay by expiration. So if all of these contracts expire next Friday, if I choose a stock or a strike price that's way far away from the current price, then theta is going to be smaller because it doesn't have to decay as much value than say if I were closer. And then I'm using a bad stock because it's kind of. But you see here, theta's much higher, so theta will be greater the closer you are to the current stock price, because let's see, what am I looking at here? Let's choose another stock here real quick. I'm looking for some large theta values. Yeah, it's okay. So we can use Tesla. So next Friday, all of these contracts will expire. Tesla's currently trading at 12.29, 12.30. So if I go far out of the money, way up here, theta is going to be small because the value of those contracts are much smaller, and the smaller the value of the contract, the less you have to decay to expiration. So to answer your question, delta and theta are the key ones that we want to be concerned about. Gamma, not so much. Vega, same. And then rho, I usually don't even have it in the chart. Other questions? Okay. So we got about 30 minutes. Who among us is having trouble? So for those of you that are already trading, you know, we've been talking a lot about selling cover calls and cash secured puts. Who's having trouble understanding that concept, either of those concepts, either understanding those concepts or executing those trades? And might have questions today that we can answer and clarify some things.
I'm not having, I feel somewhat comfortable with cash secure puts and cover calls. Mine is more along the lines of feeling comfortable with reading the charts.
Okay.
To know, like, just in general, feeling comfortable with charts.
You,
I don't know about anybody else, but that's me.
That's okay. That's okay.
I'm with you on charts.
Are you in a trade right now? Like a cover call, a cash secure put?
I'm in, yeah, I am.
Which one? Give me one.
I am in, hold on one second. Right now, I'm in Riot.
Riot?
Mm-hmm. I know how to, like, I'm gonna, what is it? Roll up or whatever it's called. I know how to do that, so I'll be doing it tomorrow.
Okay.
Like, yes, so I don't screw myself.
Okay. So what questions about the chart do you have?
Just, I guess mine would be like, say for instance, if I am gonna just do like not the wheel strategy, but just, you know, options trading, then when to get in and when to get out.
Great question. And that's going to be our next topic, by the way. So
Okay. Then
I mean down the road, but we can introduce it right now, and then you will have another quiz on that subject. But let's just talk about it.
Okay.
So let's just say, so are you in a cash secure put? What are you in?
So for this one, yeah, I'm in a cash secure put. So I get it. Like with mine, I feel comfortable with like rolling it, like rolling it out or whatever. But just in general, like that's why I feel more comfortable with the will strategy than anything else, because it's harder to screw yourself over. But
That's right.
just, yeah, when I
That's
start
right.
looking at the, when people are posting different things in the chat, then I just really bypass it, don't even look at it, because I know I'm not scalping or like day trading and everything else. It's like too much
No, that's
for me right
fine.
now.
So I would say for you and anybody else on here, big picture, now that we understand how option premiums move, now we can better time when we get in the trade, right? So let's say you're looking at Riot coming into this day, right? So if I'm seeing a sell-off, so based on what we just went through, what are those put premiums do as the stock price is doing this? What's happening to the premium?
Going down.
You don't even need to be looking at it. What are they doing?
Increasing.
They're increasing, right? And so I want to sell a put at the bottom or at support. So after a sell-off is when you're going to see my put premiums increase. And so if I sell here, I'm going to collect more than if I sell here, right?
Yes.
So when you are a seller, that's what you want to be thinking about. Even if you don't understand a whole lot about what's going on the chart, you do understand the direction. And now you understand what happens to the premium with the direction. And so you don't need to understand a lot right away. And so you can just focus on, I want to sell a put on stock XYZ. It benefits me to be patient and wait for after a sell-off, confirmation and pivot to the upside. Because if it keeps going down, let's say you got in, let's say you at the open, you got in here. So it started to sell off at the open, you sold your put here and the stock price keeps going down, down, down. So now you're going to be negative on that trade, right? Because of you sold it here, but the stock price is still going negative. And so now the value of those puts are more than what you sold them for. So if you tried to exit down here, it's going to cost you more to exit than it did to sell it. So what you want to do is be patient, try and look for where it is bottoming out and pivoting to the upside. And then you want to time it down here if you can. And so
By
now,
the way, what platform is that you use?
this is Webull.
Okay.
And I like it mainly because that's what I started with. And the user interface is a little easier. So it's like more capability than Robinhood, but less complex than like TD Ameritrade. TD is like professional. TD is like professional. This is kind of like middle of the road, Webull.
Got it. Thank you.
Robinhood is like entry level. So let's take this, right? So let's get rid of this. Let's say you sold it down here. So you got, you've optimized the amount of premium you collected, and then the stock starts doing this. So what happens to put premiums as the stock price rises?
They decrease.
Yeah, cheaper.
It gets cheaper, right? So if I sell it here, let's say I sell it for $10 a contract, and up here it's worth $5 a contract, then I can buy to close this contract and make $5 a contract for $500 if we're talking, in those terms. Does that make sense? So
Yes.
I got in at the bottom where I collected more premium than if I sold up here somewhere. You know, I waited and I confirmed that it was about to pivot to the upside. And we'll show how to recognize that using, you know, these volume bars down here. So that becomes important. You know, multiple attempts to try and break through a certain area. So that gives you confirmation that that's support, like right in this area. And then sort of a red to green move in the other direction. So that confirms that this stock is going to move higher. And so as a seller, that's exactly what you want. You want to sell if your goal is to just sell put premiums and just sell them and not ever be forced to buy them. So you can just sell puts on any stock you want. If you time it right at the bottom where you're selling here down here as support, and then the stock pivots to the upside. And let's say this is expiration day. So the stock is up here. The strike that you chose is down here that you sold. So if the strike price isn't below if the stock price isn't below your strike, then the person who bought these are going to be worthless to them. And so you keep 100% of the premium that goes into your account, and you don't have to buy the shares because it expired out of the money. So now you just look at next week to see if you want to do the same thing on this same stock. You know, I would still recommend, you know, if the stock just did this the previous week, then I wouldn't necessarily sell puts up here because of what we just talked about, right? So we want to watch this stock to see if it does something like this, a pullback. Because if it goes from 34.20 down to 32, then you know those put premiums will have increased and you can collect more. But if you sell it up here and it does this, so now you're trying to hope for it to pull back up and go back above the strike, or you'll be buying it, you know, on expiration day, you'll be buying those shares at 34.20 or whatever, and then they'll be worth 32. So you're gonna be upside down. So a lot of that has to do with just understanding what the price action is doing and knowing when to get in. So if you're selling puts, you want to, you know, sell down here, and then you want to confirm that the stock's gonna be moving that way. But let's say you're selling covered calls. So I have 100 shares of this stock, right? So I'm still trading Riot. So what is happening to call premiums as the stock price moves up to here, from here to here?
They increase.
It's going to increase, right? So if I'm trying to collect premium, I'd rather sell at the top, sell calls at the top, sell puts at the bottom. And so in the terms we typically use is, I would sell a put at support and I would sell a call at resistance. Okay. So that level, if I had, let's say I had 300 shares of Riot sitting in my account, I want to use those as collateral to sell 3 contracts, 3 cover call contracts. I'm looking at the stock this day. So at the open, the stock price is increasing. So I want to look at how much it's going to rise and if it's going to hit some resistance area and pivot to the downside. So let's say I sell up here. So I sell my 3 contracts, let's say $5 a contract or $50 a contract. So I collect, you know, $50 each. So $150 total for 3 contracts. What's happening to the value of those contracts as the stock price moves down?
Decreasing.
It's decreasing. So if the premium is decreasing after I sold for a higher premium, then the more decreases, the more I'm seeing an increase in my unrealized profit. And that means I can exit this trade so I can buy to close those contracts for less than I sold them for. And the difference is what I profit.
No, why would you want to buy the close in that instance?
Yeah, so I say in the chat a lot. So we use OCGN a lot. So I have been selling covered calls on OCGN for like 8 months, right? But I might have had a profit target of 75 to 80%.
Mm.
So if I collect upfront $500, I sold 5 contracts, each one of them for $100 a piece. Let's say my profit target is 80%. So as the stock price decreases, so if I sold them for $5, and if I can buy them back for $1, so I'm profiting, $4 a contract, times 5. And so I can, that's 80%, right? So that's when I hit my profit target, I can exit. So now my shares are at risk. So to answer your question, the reason why you would want to close a contract early is to protect the shares and do it over again.
You don't have, so you buy the close and then you just do it again and choose a different strike and a different exposure.
Exactly. Exactly. Yeah. So the less exposure to the market you have and still reaching your profit target, you get out.
Right.
You reach your goal and you get out. Now you're not exposed to whatever the stock is doing.
So you're not waiting until Friday sweating that you don't get signed.
No, you can take the rest of the week off.
Yeah.
You can come back on Friday to see what you might want to trade the next week, but you're not at risk of losing those shares.
Okay, that's a good.
Yeah. The same on the cash secured put side also. If you have a profit target for those, let's say you're not running a wheel, you're just selling puts. You hit your profit target, go ahead and exit. Or, if you're running a wheel strategy and you don't really care. So let's just clarify that too, right? So who was it asked that original question about the chart? Sabrina?
Sabrina.
Okay.
Yes.
So Sabrina, she, she's not really worried about being assigned because she's running a wheel, right? But some people may not ever want to have the shares. They just want to sell these cash secured puts. So I hit a profit target and then I'm out. But if you're running a wheel, you can just sit back. Don't worry about it. If it does this, then you just let it go. Because if it stays above your strike price, then you'll keep 100% of that premium you collected up front.
So by doing that, by doing the buy to close, you're also giving yourself a chance to make more money because you get back in the game. You can do it on a Wednesday or whatever, and you just do it all over again.
Yeah.
Because
the premium tends to be higher on Fridays.
I'll be damn. Okay, I've been having money left on the table waiting until Friday. Okay.
Don't make that assumption. So
okay.
Don't say the premiums are higher on Friday because most expiration days are Fridays.
Right.
We already know that out of the money premiums are going to be worthless. So if you look at this stock tomorrow, towards the end of the day tomorrow, all of these, if let's say Riot stays here at 32, whatever it is, anything above that, these are going to go to 0 for tomorrow.
But I'm talking about like if you get out on Friday before it closes and you're entering for the following week, a lot of times the premium is more.
Oh, yeah. So
that's what I meant. I'm sorry for clarification.
I agree. So remember what we talked about? Let me find that.
So you sell on a Friday for the next week,
Yeah, you wouldn't be selling on a Friday for the current week because
Yeah.
right? Because I always thought the premiums would be so high. You're selling before it closes. Okay, there you go.
Correct.
Before
Yeah.
you're just getting into your following week's trade
early.
early.
Yeah. So you're getting your money, you know what I mean? Like you're getting
Yeah.
out of that trade. So then that way it frees up cash for you. to
Very
jump in.
good.
Frees up the cash and the buying power to take another trade for a future week.
You guys got me. That's perfect. Thank you.
If you're still holding that current trade for the current week, then you got to use more buying power because now you got two trades until you close one of them.
Yep.
Right?
Damn. Okay, that's beautiful.
Okay, so let's go back to that point. That's a good point that we'll hit on. It goes back to the more we talk about this, the more you're gonna like this cheat sheet. It's kind of probably too detailed at this point, but 1 second, let me find it. So you're gonna want to print this out and post it somewhere. And I take full credit for it because I created it. But remember that time value? So each option has a time premium associated with it. So the farther out you go, who mentioned that? I'm sorry. Who mentioned the higher premiums?
Sabrina.
Sabrina, sorry about that.
Me. Sorry.
So all the videos, and I can't see, it's on a different screen. So and I haven't learned the voices yet. So Sabrina says, if you go further out, the premiums will be higher. Yes, because of this time value. So the premium, the farther out in the future you go, the more you pay to potentially hold that contract for that amount of time. So that's why it's more expensive. That's why leaps are more expensive. If you go a year or 2 years out, they're going to be way more expensive than if you buy the same strike for next week. That makes sense?
Yes.
Okay, so we can prove that real quick. So if I go November 12th for this stock riot, if I take this deep in the money strike 15, this is weird. Oh, this is put some time. Let's look at the calls. If I look at this 15 strike, 17.15 is what it would cost me. So $1,700. If I go far out of the money, 15 is going to cost $2,400. So you pay a time premium, the more time to expiration on the contract for the same strike price. Make sense?
Is that a put? Let me see.
These are the call contracts.
Okay, so wouldn't that be, let me see. What number did you choose? Now, wouldn't that be?
I chose a 15 strike right here.
But it's 32 right now.
Yeah, so the stock price is 32. So this 15 strike is deep in the money.
Okay.
In fact, it's got a delta of 1. Remember we were talking about?
Right.
Yeah. And so if I choose this 15 strike that expires next Friday, so if I go long on it, if I buy it, I'm going to pay $1,700 for it. If I go 2 years out, or January 2024, for that same strike, I'm going to pay almost $2,400 for it. You are paying for the ability to hold that contract much longer than next week. And so there's a premium associated with the time remaining or the time of expiration on those contracts for the exact same strike price. That makes sense?
Yes. So in your experience, like when you do buy further out, like a leap, do you recommend over 365 or do you recommend like 2 years? Or 6 months,
What I tell people, it depends on what you're trying to do. So if you're trying to
I'm trying to sell covered calls on it and make money on that same option.
Yeah, so if you're trying to sell cover calls on it, what I tell people is I go as far out and as deep as I can afford.
Okay, it's all about your own pockets.
Yeah, it's all about your own pockets. So you can use that delta range that we talked about.
Yep.
And so you might look at this stock and say, January 2024, I wanted the 20 strike, but I don't want to pay 2,200 for it. So maybe I go a year less. So let's see what the 20 strike is in 2023. No, it's $400 less. Maybe I can swing that.
Right.
So I might go a year less, pay a little less, but then I'm ready to rock with my selling my cover calls.
So do you prefer, or do you recommend either weeklies or monthlies, or what time period? Because I currently do weeklies because I feel more confident in kind of the pricing.
Yeah.
My
So
strike price.
You can do so we just did an exercise, right? And so what we said is the further out you go, the higher the premium is going to be.
Yeah.
And so by that understanding, we automatically know if I sell a monthly instead of a weekly, the premium is going to be higher, but that means I may have to hold it longer. So it becomes really your strategy and your trading style to determine, do I just want to collect more upfront and not have to manage this daily because it expires in a week?
I don't mind working like
Or
that.
I collect more upfront and then maybe I only look at it once a week because it expires a month from now.
So, because just listening, I don't know if I got this wrong or not, just listening to you and Sabrina, I can do the same call. I mean, I can do the same transaction maybe twice a week. But if I close it like if it's a great, if I can make my 75% by Wednesday, close it out and then put it out there again until Friday.
No,
No.
because the premiums will not have changed much, right?
Okay.
You can
If you
close
do
it.
any of those, I would do SPY.
If you do any of those, do
SPY.
SPY. Exactly.
Okay, perfect. I'll start.
SPY has 3 expiration dates per week. So you can do a 0 days expiration, so open and close on a Monday, or you can open on a Monday and close it on a Wednesday, open on a Tuesday, close on a Wednesday, open on Wednesday, close on Wednesday, open on Wednesday, close Friday. So you got a lot of options on SPY.
So those that use SPY, are you guys using the leaps on that, or are you actually buying the 100 shares?
I did both. It obviously is much cheaper doing the leaps and just doing the poor man cover calls.
Right.
But then, like you said, doing the I would get in on a Friday and I think I get out on a Monday, maybe. I can't remember, but I know it was 3 times a week. It's not a lot though.
Right.
$10, $20. So, I mean,
Looking at
do 4 weeks, and to me, I was looking, if I do 4 weeks, I can almost equal that 1 month premium most of the time. It doesn't always equate that way. It actually never really equates that way, but
right.
Yep. It almost all kind of washes itself in the wash. I guess it's basically how much work you want to put in.
How much work you want to put in, what the stock is doing at that time. The stock may have, let's say you're selling covered calls. OGCM was flat for a while, right?
Yep.
And so you can sell a weekly, but you're probably not going to get a lot because the stock has been flat for a while. Remember what we just talked about? Ideally, you want to sell after a run up.
Yep.
The premiums increase. So if a stock is flat, you may choose, you can look at the daily and the monthly to see what what the stock has been doing over the last month. So if you look at our OCGN, if you're selling weeklies in here, you're not making that much.
Right.
If you sell a weekly after they did something like this, you'll make a lot, right?
Right.
Because you sell it up here versus down here at $7. So an $8 move, $9 move, you collect much more premium on a weekly than you would if it's just trading flat.
Okay.
And if it's trading flat, and if it's been trading flat for a while and there's no news, no catalyst that'll drive buyers to drive the stock price up, then you may want to consider going farther out.
Right.
So maybe I go 2 weeks out. Maybe I go a month out because I want to collect more premium. It's your choice. Good questions, though. We got 5 minutes. What else? So Sabrina, did we answer your question on how to read the chart?
Yes.
We'll go deeper in the chart.
Sure. Yes.
Yeah, we'll go deeper in the chart reading later, but just in general, if you just remember this, if I'm selling puts, I'm looking to sell those after a sell-off, where the put premiums are going to be higher. If I'm selling calls, then I want to sell the calls at the top after a run up, where the put premium or the call premium is going to be higher.
So you do support and resistance lines. That's how you base yours on.
That's how I base all my. I don't even take a trade unless I've done it.
Yeah.
That's what we got to learn.
Yeah.
That
So
part.
all these lines are me drawing support and resistance at some point, and they never go away. By the way.
Yeah, they stay the same.
They stay the same. So a support. So if you look at this, right? So look at it, take this line right here, right? So this line all through here is resistance. People are buying this stock, but it can't break through this level. And so it hits this level, fades, and it trades below it for months. It finally breaks through. But now this is support. So now it sells off and it hits the same level, but then it bounces off this level and moves higher. So you can have a level that was once resistance and it's now support. So if you've got lines drawn and they are good levels, you don't really ever have to delete them because they're always going to be in play when the stock price is trading around that level. You just have to figure out how to learn out how to do it. And you don't even have to be exotic with it. I'm not. I just do, basic charting.
Just like 701, I mean, why would that be your support? I mean, I'm looking at the touches. I don't see where.
That's where the buyers are. So if we're talking here, right?
How did you determine 701 though? I mean,
oh, I got you. I don't remember. Like I said, I've been trading the stock for almost a year. So it could have been way in the past.
Okay.
Right. But that's my point. You can draw a support and resistance line way back here, and then 8 months later, it's still in play, just like I mentioned.
Okay.
Right?
Okay. So that might have been a bottom back several weeks ago or something.
A year ago. Yeah. It could have been a year ago.
Right.
Yeah.
Zach, this KD, there's still no options for a person who works all day and trying to look on their phone the chart. I just got no help with it. I just got.
Oh yeah. So speaking of this support and resistance thing, I find it almost impossible to do it from your phone. Maybe you are better than me and you can use your fingers to draw these lines on a 2-inch screen. I can't.
Bar chart gives you you can do it on bar chart on your phone.
And do what? You
can do support and resistance lines on your phone on if you use barchart.com.
Okay, but you're still dealing with the same real estate, right?
Yeah, same real estate though. Unless you can turn it sideways.
Yeah, I got you. So you make it a little bigger.
Yeah. It's not the most ideal way, but
my recommendation has always been I can enter a trade. I would never enter a trade on the phone. I can easily exit a trade on the phone because it's just a couple button clicks. But if I'm trying to do all of this kind of stuff, then I'm going to be on something with a larger screen. But that's just me. It doesn't have to be done that way.
That just means I need you to post quickly after you're done what you do.
That's true. That's true. So I don't really do call outs. You know, we do teaching you how to trade and then you can do it on yourself, but that's what we'll be doing in the future. We'll be doing more call outs, but we'll have a more informed group of folks, right? So right now we do call outs and they probably don't make sense to maybe 2 people, 5 people at most. But later, you know, 90% of the group will understand what that means because we're going through this training.
I have a
Is
question.
that,
Oh, I'm sorry.
DJ,
Yeah. So I sold all my shares, and then I got assigned last week on OCGN for another the other shares that I had. Do you think it's best if I wait before I do a cash secure put on OCGN to kind of see where it's gonna go over the next week?
so let's unpack that. You sold all your shares of just different stock positions? Is that what you're saying?
I had 200 shares, so I sold 100 shares at the top that were kind of free. I wasn't selling covered calls on at the time.
Okay.
And then I got assigned the previous week for the other shares that I had.
So you were selling cash secured puts?
I was selling cash secured, covered calls.
Well, you didn't get assigned then. You got your contracts got exercised?
Yes.
Okay. Does everybody understand the difference between assign and exercise? We can hit that real quick.
Did she say she was selling covered calls and she got assigned?
Yes.
Yeah, but the right terminology is exercise. So if you are the seller of covered calls and your shares are being taken away, then those have been exercised. When you are being assigned, you're having to pay for the shares. Make sense?
Yeah.
So if
mine got
I'm
exercised.
selling cash secured puts and those puts expire in the money, then I'm obligated to buy those. So I will be assigned those shares and the money will come out of my account to pay for it. So being assigned, you're receiving the shares, exercise, the shares are being taken away from you.
Yeah, so they got exercised.
Okay, so that exercise and you don't have any left, right?
No, I'm bare and I'm trying to find something that I'm like, maybe I could do a cash secured put or something. But
So that's what you'd want to do, right? So we had, so you did the right thing. So you sold at the top, right? I don't know where you sold, but you made profit on it, right?
yeah, I sold it was like 16 and something, but my cost basis was 672 or something.
That's good. That's good. So you made $10 a share or close to it. But if you're gonna be running cash secured puts, remember what we just talked about? So if we're looking at selling puts, collecting an optimal amount of premium, this is what we want to see. So we don't want to sell cash secured puts up here. We want to sell them down here. So the put premiums, when you look at next week or the week after, whichever ones you choose, they're going to be much higher than if you had tried to sell a cash secured put up here. So this is what you want to see. So you can go back into OCGN. You can look at those real quick, right? So I want to sell a put. Current price is $10, right? So if I am comfortable buying OCGN, you know, you could even go, depends on where you want to buy it at.
I really want to buy it at $7.
You want to buy it at $7. So you would collect, you know, not a whole lot, $16 a contract.
Yeah.
So you might have to go farther out. So it gets a little higher the further out you go, right? So I went 1 week later. You know, the cash secure puts that you sell, they don't have to be expiring next week. You know, you can go 3 weeks out.
Before, when I was doing the cover calls, I was just selling them on a week-to-week basis because I didn't know what the news was going to be.
Right.
And I didn't want to lose my shares, so I wanted to keep on making the money on them. So I mean, even if I did buy at a or sell a cash secured put at a higher price, I'll just sell covered calls against it if I do.
Yeah, if you're running a wheel, then I'm trying to get as close to the current price as I can afford.
Okay.
Because I know I'm going to collect a whole lot more premium. So if you're doing a weekly, right? So next Friday, you want to find a cash secured put. Yeah. $135 per contract. So if I sell 3 of these, I'm going to collect $400 up front. And then, you know, if the stock price remains above 10, that's $400 that I made, and I don't have the shares. If it ends up at 9.5, I'm buying those at 10, and then, like you said, I'm turning around and selling calls next week, probably 1 strike above that. So, you know, I'm still going to be collecting on both sides of that trade. Right?
Okay. Gotcha. Okay.
That makes sense?
Yep.
Okay. But but you did the right thing in terms of when you got out. So you got out at the top, not quite at the top, but you know, I do that all the time. And I posted in the chat, well, I just left a whole lot of money on the table. That's okay. You profit. As long as you're profiting, you can't go broke on trading in the stock market.
Zach, this may be a redundant question, but I need to make sure I'm clear on this. I've never done cash secured puts, right? Because I've always did a cash account. So I just added $3,000 to my account, which gives me a little bit more cash. But my question is, I think you may have stated it, is that if I select a strike and that price falls below that strike, I'm purchasing those shares at that strike price per 100 shares, right?
Right.
Okay.
Yep. And so that's what that max loss is. It's kind of confusing, but if you were to go and sell this $10 strike, so I'm going to sell 1 contract. It didn't even show it. Why didn't it even show it?
I think maybe if you hit the graph instead of table, then it should show the max.
Yeah, it's weird. And normally it would have a max loss down here. Oh, I know. Let's go here. Wrong area. I don't know. We will do weird stuff after hours, but normally there would be a max loss right here, which is just how much it would cost you to buy 100 shares of this stock if this expires in the money. And it would be, so let's just take this, we can do the math real quick. So it's gonna be the strike price times 100, right? So you're gonna be buying 100 shares if this expires in the money. So $1,000 minus the premium you collected. And so you'll be showing a max loss of like 840 over here. That just means the net cost to you if this expires in the money is going to be $840 because you will have already collected 160 if you sold this contract. Does that answer your question, Katie?
Yes, sir. Appreciate it.
Okay.
I just need to make sure I got the cash and then the cover.
You have to make sure. Yeah, your broker. If you don't have enough cash in there, the broker will just reject the trade. So you'll know because the trade won't go through unless you've got a margin account and you're trading on margin, but I don't recommend it. Okay, so we ran up 10 minutes over and we could probably call it. We had a lot of good questions though. So hopefully, was that helpful?
Yes, it
Yes,
was.
it was.
Thank you so much. Appreciate you.
Yeah, you're welcome. So we will, so we'll start building on this, right? And so a lot of the questions that we were asking today about the wheel cover calls. So now I can probably reintroduce a quiz that we did before you all joined that sort of gives you practice in trying to understand the stuff that we just talked about, where you would want to sell cover calls, where you want to sell cash secured puts, looking at a chart, and then understanding how much premium you're collecting and how much you profit on the total trade at expiration. So we got some quizzes related to that too. So that's just sort of reinforces what you learn and build on your understanding of the Greeks. So with that, I think we can call it. I enjoyed it. Hopefully you walk away a little smarter than when you came. We'll do it all over again in like a couple of weeks.
All right. Thanks a lot, Zach.
Thank you.
Thank
right.
you.
Have a nice night.
Have a good night.
Good night.
You made